Hello and welcome to this week's US market news summary from Ferrari Financial. Well, it was a big week on Wall Street, an excellent rally all week really, due to the unexpected earnings reports of some of the top players, meeting expectations and in some cases exceeding expectations. Are we impressed with the earnings? Well, not really. We feel that it's too early for the real problems to have filtered through into corporate earnings. So the first quarter we didn't really expect to see showing the full results of the downturn. We do feel that this will be more prevalent in second quarter earnings reports. Plus, of course, the financial press are clinging on to every little bit of good news and blowing it up out of all proportion in an attempt to try and bolster up this market. So if the rally were to continue next week, our advice to everybody would be to sell into that rally, because we do feel that the rally will be cut short quite soon and selling will resume again. The action this week doesn't really make a lot of sense to us when you have the largest bank in the US, Citigroup, posting a 5.1 billion loss for the first quarter on top of a 10 billion loss for the previous quarter. And that is cheered by traders, and the stock and the overall market is moved up rapidly on such news. Just seems utterly ridiculous to us. We feel the market's just clutching at straws at the moment. Let's take a look at our Nasdaq chart. We're going to take a look at the one-year chart now for the Nasdaq Composite Index. We want to focus really on the events of the last few weeks, where we've had this massive sell-off really since the beginning of the year. Really from just before Christmas we had this continual sell-off right the way down till the Nasdaq actually just above the 2,200 mark. At 2,208 was the worst level before we had the pullback that we've had in the last week or so on the promise of a nice fiscal package with some tax cuts. And of course the Federal Reserve stepping in with an interim interest rate cut, followed by further cuts at their end of January meeting. And this very nicely pulled the market back up, as you can see here, coming back up to this line, this brown line, which is in fact the long-term 200 moving average. This is a long-term average line, and when you see that penetrated, that's always a bad sign. We're back up to it now, but we do feel that if we look at the trend line that's forming, possibly covering the peak, and then across the pullback that we had just before Christmas, we're heading down at an angle of something like that. If that's the case, I'll just set that in so you can see it. There we go. Oh, one more try. There it is. Now, if we see this pullback coming back up to about, at the most, about 2,500, then we're back up to where that trend line would intersect it around about here, and that's probably the danger point where this market could turn south again and continue what would be a much more prolonged downtrend. We do think this is probably the scenario going forward into the spring and early summer, because we do feel that we've seen the head and shoulders pattern fully developed here. The right shoulder, the left shoulder here, followed by the head pattern, and then the right shoulder forming just before Christmas. Now we've had the penetration of the long-term average line, and we do think that in a classic scenario we would see a little bit more of a pullback of consolidation over the next few weeks, before then the market would probably turn southwards again. So with a 700-point rally in the Dow last week, you would think that the signal there is that maybe this recession that we've had, this downturn since November, could be showing signs of being over, but we think that you would be wrong if you made that assumption. We think it's more prudent to be selling into this rally now and positioning yourself for the next down leg on what we consider to be only half of the bear market showing at the moment. So as the market level for the Nasdaq Composite Index approaches the 2,500 level, we feel this is going to be a very critical level, and the market should encounter severe resistance at this point, and we doubt very much if the market could break through that long-term 200-day moving average and continue the rally any further. Our technical analysis of the situation is showing several factors which lead us to this conclusion. First of all, the approach of a very substantial previous support level, which supported the market going back over the last year or so, could now and will probably turn into a resistance level going forward. And the 200-day moving average, which would be unlikely to be penetrated if in fact we continue a downtrend and continue this bear market. Another reason for our doubting the continuing strength of the rally is because last week's sharp move upwards was accomplished on really quite low volume levels. So we feel that when the real turning point comes in this downturn, we should be seeing far higher volume levels for it to really be meaningful. We'll be watching the situation very closely for more earnings reports this week, and until next week, it's goodbye from London.